Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner with our June monthly market update. Before I begin, I want to thank our valued clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. We hope to see many of you at our upcoming quarterly investment forum, mid to late July. You'll be getting a notice on that soon. So we will jump in. There's still a lot to cover this week, and we'll begin with a couple of internal announcements. Congratulations to Eddie Martinez, a financial advisor here with us 3 years last month on May 18th. And Valerie Roque celebrated 6 years with us on May 30th. So we thank both of them for their service to our team and to our valued clients. So we've had a positive year for stocks thus far. And just to look historically on what that means going back to 1926, if you have a positive January through May, on average, this is the return June to December. So overall, it's up, but it's up more if you start the year well. So that's a positive sign for markets the back half of the year. While we are up year to date, we're still about 12% off of all-time highs that were achieved in January of last year. NVIDIA is the newest member of the $1 trillion club. You'll see other names that are very familiar, top of which is Apple at just under $3 trillion. And we'll talk a little bit more about how tech is really leading the rally thus far this year. In fact, there's just 5 stocks, including NVIDIA, that is accounting for 96% of the gains of the S&P so far this year as of end of May. And this is just kind of a look, and this is actually a little bit dated on Apple's market cap. But if you compare Apple's market cap to the world, it's greater than the entirety of the UK market and greater than either France or Germany's market. And this is just another look at kind of market breadth thus far year to date from Barron's. Through late May, the S&P was up about 8 versus a negative 1.2 if you have an equal weighted S&P 500. The S&P 500 being market cap weighted, that delta of 9.3 percentage points is only bested by 99 when it was at 9.3. And then the prior year, 98 at 16.3. We all know what happened after 98, 99 when the dot-com bubble burst. Not predicting that for this, but it is something to watch as the market breadth thus far this year is very, very narrow. So what's the Fed going to do next? The Fed has raised rates. We've talked about this before 10 consecutive times. They're starting to forecast the next move being actually a cut in January of next year and moving into pause mode. Now, we'll see whether the Fed pauses or not this month and beyond, but that's what markets are indicating. So a great jobs number from May, average hourly pay up 4.3, unemployment 3.7, and over 300,000 jobs added, which was more than expected. Real GDP thus far this year, the last 4 quarters, the most recent quarter being 1.3. Like we've said, the most recent Fed rate increase is 0.25, which is 10 consecutive rate increases since the beginning of last year. One of the things to be looking at is if we get to a point where we've gone through the last interest rate hike, what that means for stocks. Going back 30 years, this is the average 12 months after the last Fed rate hike. So you'll see broadly good for stocks, better for US than non-US. We all know about the kind of a highly publicized bank failures that in part were due to the Fed raising rates so much with 10 consecutive rate increases. This is how those fare compared to WAMU back in the 08-09 timeframe. Whether this is a contagion type of an event with the 4 banks that have failed thus far this year, we don't know, but it's definitely something that we're watching. And a more subtle issue may be just the tightening of credit and the more costly credit. So even if there's not a contingent of more high-profile banks that fail, lending standards could increase, cost of money can increase, and that could kind of, in effect, um, have an effect on the broader economy. So the long anticipated recession is not yet here. There's still more than 60% of forecasters believe we will have a recession in the next 12 months. What we don't know is when one will happen, how severe it will be, and to what extent the market's already priced in a recession. But again, that's something that we're carefully watching. We did see inflation on an annualized basis go under 5%. That's both good news compared to June of last year at 9, but it's also still well above where the Fed's target is. So again, what the Fed continues to do, we'll see in the month of June, whether they go pause or whether they increase again for the 11th straight time. That's something that we're following very carefully. If we can view June of last year as peak, this is a look at what assets did, stocks and bonds, the next 12 months. So you see overall that's pretty good. On average, stocks over the next 12 months up 18 and bonds up just about 8. So we hope this overview gives you some broad perspective on what's going on in the markets. Again, we hope to see many of you at our July quarterly investment forum. We expect over 100. We'll kind of talk about the markets in the first half of the year. But all of these things are no kind of substitute for contacting us directly. Please leave no question unanswered and contact us if you have any questions at all. So with that, we'll close. Again, we want to thank you for the trust and confidence that you place in us. It's our privilege and our honor to serve you. If we can help you in any way, please do not hesitate to give us a call. Until we see you again, be well and take care.